fair to say that the easy money, if there is such a thing, has probably already been made in stocks. We expect quite a bit of volatility going forward. We've been consistently and adamantly bullish the equities since late 2018 when the market fell out around Christmas time. But we can no longer justify that stance. While we acknowledge there's a chance for at least one more leg to the rally, in fact, we do think the S&P will likely see the 3,000 to 3,030 area before rolling over. We believe the risk of being long and wrong is elevated, while the upside profit potential is relatively minimal. Unfortunately, we've also been bullish agricultural commodities such as corn, soybeans, wheat. Those markets have not fared so well. We can't help but dwell on the fact that while the stock market is pricing in a relatively best-case scenario when it comes to the Chinese trade deal with the U.S., the agricultural markets, such as soybeans, corn, and again wheat, are pricing in something that resembles the worst-case scenario. While we're seeing stocks near or at all-time highs, we're seeing the grains at or near decade lows. Both of these markets can't be right, and we believe they're probably both wrong, or at least partially wrong. We're expecting some sort of reversion to the mean, and this would mean lower stocks overall and higher grain prices. We all know that the markets are basically emotional roller coasters. Accordingly, as people get excited or fearful, I should say greedy or fearful, the markets react accordingly. When we look at the CNN Money Fear and Greed Index, we've noticed that the market is not extremely greedy, but it's behaving in a greedy manner. The CNN index looks at several parameters to determine whether traders are confident, complacent, or even greedy, and we're getting into the greedy stage. On the flip side, if you look at sentiment readings in the grain markets, for example, the consensus bullish index is showing that a mere 20 to 25% of those polled are bullish in grains. Anytime you get a reading in the mid-20s or low 20s, it suggests that most of the traders that are bearish are probably already in. Further, the COT report is showing record net shorts in the grains. So again, we're looking at markets that are extremes in price and extremes in sentiment, and we could see some reversal. If we're right about a mean reversion trade, that could mean soybeans running back into the $9 area. And it could mean the S&P falling back into the 2650, 2700 area. That said, if things get out of control and fundamentals dramatically change, we could see something even bigger in each of those markets. We wouldn't rule out 10 to 1050 in soybeans, and nor would we rule out a retest of the 2450-ish trendline support in the S&P. While those levels aren't necessarily expected, they should be respected.